Okay, now we're going to separate the investors from those who play the stock market. Yesterday I showed you the metrics that is on our website and how you can determine whether a company is in a position to make money with your investment and what their past history was and what the probability is that you will make a growth in your investment. Then I showed you what I call growth opportunities. My analysis that says that if a company recognizes a growth opportunity, the first thing they're going to do is go to the bank and they're going to ask for some money to finance their growth. The second thing they're going to do is hire employees to make that growth happen. And I showed you a stock by the name of Navitas, and that they had increased their employee count by 37% over the past 2 years, and they were showing a growth in revenues of 142%, and I projected that they were going to grow substantially. Now, they are a small company. I bought more shares, 2,000 more today, at about $2.30. So that means they aren't making money. So how do you determine the future value of a company that is not turning a profit, that does not have a PE ratio? You use what is called an enterprise value. Now, what I'm going to do is show you how you work with an enterprise value and figure what the price of Navitas, which is selling now for $2.30 a share, how it's going to grow to a price of $8.72 by 2027, and how it's going by 2030 be at $24.93, and how by 2032 it's going to be at $47.50. That's if it stays with a multiple below its industry average. Whereas if it meets its industry average, that $47.53 in 2032 will turn into $65.54. Now, this is deep financial analysis. If that's something you don't care to learn how to do, you probably need to turn the video off before I step over there and go to my computer and explain to you exactly how this is done and how you can do it for yourself. First, we have to recognize a growth opportunity. And the growth opportunity we recognized was Navitas, which is down 62% this year. But over the last 2 years, they've grown their workforce by 37%. That tells me they're getting ready to grow their business. They're also showing 142% growth in revenues, but not a corresponding growth in income. So it hasn't really kicked in yet. So this looks to me like an opportunity for me to come in. So I need to then project what is the price of the stock going to be in the future. And normally I would do that by taking their projected growth in earnings per share and putting that against their PE ratio. But they don't have a PE ratio because they're not making money. So instead, I'm using enterprise value. What is enterprise value? Well, if you went to buy the company, the raw company, all the shares of the company from all the shareholders, what you would pay would be the market cap minus any debt. They'd have to pay that off, and minus any cash. So you would just be buying the raw company. So that's its enterprise value. So that's what we use as an equation. And we find out that the enterprise value is a multiple of 4.3 of sales. So as the sale or revenues. So as the revenues go up and we stay at the same multiple of 4.3, we can then say that the price of the stock will go from the end of 2024 at $2.30 to $3.92. And then we carry that equation across. Again, saying the enterprise value stays the same, but the price is reflectant in the increase in the revenues, which then changes the enterprise value, because the enterprise value is a multiple of the revenue times the enterprise multiple. So we come out that the price goes up all the way in 2032 to $47.53. Does that make sense? Okay. It's a use of the numbers that we can acquire on the internet to project what this growth opportunity that Navitas has in front of them. And I've gone over that before. It's a different kind of wafer. It's not silicone. It's a combination of nitrogen and gallium. And it reflects the heat better so that these high-powered GPUs can be more efficient. And as they increase the AI need of your phone, this silicone or this wafer will end up in your phone as well. In any vehicle or any whether it's a phone or your laptop or your computer or in a data center, the Navitas's wafers will be preferred. Now, what is this line? This says if their implied enterprise value, which is the enterprise value of their industry, is not 4.3, not the multiple is not 4.3, but instead it's 5.93. If it should come to that, that will be reflected in its price as well. And so you can see in 2025, rather than $3.92, it's $5.40. And then all the way to 2032, rather than $47.53, it's $65.54. So does that make sense? So now you know how to do this calculation on any stock that you find where there is a growth opportunity, and that's signaled usually by a growth in employees. They're gearing up for the opportunity, and in many times a growth in their debt. But Navitas has no debt, and they are not borrowing money because they have cash in the bank to finance this growth opportunity. I know that. How do I know that? I listen to the earnings call. I analyze their financial statements. I analyze their income statement and their balance sheet, and I come up with this information. There, now you have it. Now you understand how to take any stock, whether it's got making profits or not, and evaluate it in such a way, particularly when you recognize there's a growth opportunity. They're borrowing money, they're increasing their workforce, they have an opportunity, and now you know how to go in and use their enterprise value to determine what the price is going to be in the future at their current multiple or at a different multiple that might be more standard for the industry. Okay? I hope that helps you, and I hope you go and find your penny stocks and whatever, whenever you see it or suspect there's a growth opportunity, now you know how to do it. Now, if you don't want to spend your time doing that, like I do, then you join someone who you either get with a Goldman Sachs or a JP Morgan, a financial analyst, and you ask them to manage your portfolio. Or you come join the tribe. You know, it's up to you. And we have a 14-day free trial where you can come and get more acquainted. We're constantly changing our website to share this more and more of this information so that you don't have to learn how to do it yourself. But that's up to you. Talk to you more in the future.